Now, since 2003, as you know, the ECB has used a double key formulation to set our objective, defining price stability as a year-on-year increase in inflation of below 2%, while aiming for inflation of below but close to 2%. And this formulation was perfectly appropriate at a time when the ECB was seeking to establish credibility and too high inflation was its main worry. As our research shows, it was a key factor in successfully capping inflation expectations. But things have changed, and in the current environment of lower inflation, the concern we face are different, and this needs to be reflected in our inflation aim. Ensuring that there is sufficient space above zero to re-empower conventional monetary policy becomes more important. And to underpin inflation expectations, we need to ensure that our aim is perceived to be symmetric by the public. So we should have an inflation aim that is credible and that the public can easily understand. The second issue is the horizon over which price stability should be achieved, which is captured by the ECB's medium-term orientation. This forward-looking orientation reflects traditional and well-established principles of prudent monetary policy, which is consistent with the notion that monetary policy works with a lag and can influence inflation over the medium term rather than the near term. But within the ECB framework, the medium-term orientation has also been a way for the Governing Council to take into account what is happening in the real economy, including employment. We have a hierarchical mandate with price stability at the top. But the medium term, which is a flexible concept, allows us to avoid unnecessarily constricting jobs and growth in the event of a supply shock, which temporarily pushes inflation up and generates an economic slump. The low inflation environment, nonetheless, creates some new questions about how to operationalize the medium term. For instance, the existence of large and persistent disinflationary shocks related to, say, the ability to compare prices more actively via the internet and diversify suppliers is likely to call for more flexibility. But a persistent failure to meet the inflation aim can feed into inflation expectations and would call for a shorter policy horizon. We also need to reflect on our two-pillar approach for assessing developments in the economy, which uses both economic and monetary analysis. Cross-checking between the two helps determine the risks for price stability. The monetary pillar could in principle be enhanced to provide information on financial stability, which over longer time horizons could be relevant for the inflation outlook. Some central banks have also considered adding a backward-looking element to the policy horizon in response to the low inflation environment. In the ECB's case, the reference to underlying inflation dynamics in our forward guidance means that we already look at the past when deciding whether to change policy. The wider discussion today, though, is whether central banks should commit to explicitly make up for inflation misses when they have spent quite some time below their inflation goals. If credible, such a strategy can strengthen the capacity of monetary policy to stabilize the economy when faced with the lower bound. And this is because the promise of inflation overshooting raises inflation expectations and therefore lowers real interest rates. While makeup strategies may be less successful when people are not perfectly rational in their decision, which is probably a good approximation of the reality that we are in, the usefulness of such an approach could be examined.